Hello, everyone, and thank you for tuning into our latest FTF Exchange podcast. For this podcast, we are speaking with Alexander Sokol, founder, executive chairman, and head of quant research at CompatibL Technologies. CompatibL is a trading and risk solutions provider that Alexander founded in 2003. In 2022, Alexander was voted FinTech Person of the Year through the FTF Awards competition. CompatibL also won the Best Digital Transformation Solutions Provider in 2022. Today, we're going to talk about the trading and risk models that leverage machine learning. So, Alexander, could you quickly remind us who you are and what you do at CompatibL?
Thank you. My name is Alexander Sokol, and I'm the founder, executive chairman, and head of quant research at CompatibL. I'm here today in my capacity as the head of quant research to talk about the new model types that we've developed to encoder market models.
Okay. So could we quickly review the market conditions that are creating the need for this innovation? First, how has the global rise in interest rates changed the landscape? And how have rising interest rates contributed to the need for better modeling?
Well, the global rise in interest rates created a situation where recent history of near zero rates for major currencies no longer represents the likely future evolution of rates. In most of conventional interest rate models, the models that financial institutions use to measure the risk or to price derivatives or to price value adjustments, are based on modeling incremental changes to the initial interest rates. The further they go from today's market, the worse predictions of these models become. And the incremental approach of conventional models that works best for small changes in interest rates in quiet markets, it becomes a lot less effective during market turmoil when rates change rapidly and when the future evolution of rates takes them very far away from the initial state that we're starting from today. So the new model types that we developed, which we call autoencoder market models, are based on training the models to the entire history of interest rates, not only for the currency we're modeling, but also across all other currencies. And this historical data that we are training our model to represents all kinds of market regimes. So in the past, some currencies like Japan, rates were very low, near zero for decades. In other markets, the rates were very high. So by training the model to all of the rate regimes across all currencies, these models become more effective following a change in market regime, where today's markets are going to be followed by rapid evolution. And wherever the evolution takes us, we will always find in the historical data a similar market regime, and the model will be able to present this regime well.
And just very quickly, how long does it take to train a model?
With any machine learning, of course, training is the most computationally intensive part of the effort. But these models, they work with data that's, there's a lot less data in financial markets compared to, for example, language models, of course, that everybody is talking about these days, or image recognition models. So these models, even if you train them on a regular machine, they don't take a lot to train. They take minutes, an hour, a couple of hours to train. But the important thing is that you only have to do it most frequent once a day. Usually we would recommend to do it even less frequently, for example, monthly or even quarterly. So the training step for machine learning model, which is computationally intensive, is actually not what you do when you run the model in production. It's when you train it, and you train it periodically, not more frequently than once a day, and sometimes even once a month or once in a quarter. Once you run the model, the speed of actually using the model is similar to the speed of a complex analytical solution or a semi-analytical solution. So if anything, machine learning models, they are slower to train, which you have to do rarely. But when you run them, they outperform methods such as Monte Carlo or finite differences, differential equation solvers, and their speed is comparable to semi-analytical or analytical solutions.
Oh, great. So just to take a little detour here, let's start with a step-by-step definition. The textbook definition of autoencoders is that they are machine learning algorithms that can compress high-dimensional data into a low-dimensional space. Let's start by defining high-dimensional data. What do you mean by that term? And same question for low-dimensional data.
Of course, a lot of machine learning and math definitions, and these mathematical concepts actually have very specific meaning in relation to financial markets. So let's start from high-dimensional data. So financial data for interest rates and other asset classes is high-dimensional in the sense that each observation consists of many individual market quotes. If you're talking about a stock, for example, and let's say you would like to see, what value your stock portfolio has, you only need the stock price. But a yield curve, right, the curve that represents yields of bonds or swaps or interest rate instruments of different maturities, consists of 10 or 15 quotes for different maturities, and the model must represent them together because they depend on each other, they evolve together, they cannot be modeled independently. So that's already 10 or 15 dimensions, right, where each dimension is an individual market quote. Now, if we talk about volatility surface, namely volatilities of different types of interest rate options, if it's a surface, it has two dimensions. One is the maturity dimension. It consists of options of different maturities. Another one is a strike, right? Namely the strike of the option. So there we get, between 50 and 100 individual market quotes, so the dimension becomes even higher. For swaptions, which are options to enter into an interest rate swap, you have three dimensions. One is the time until you have to decide if you're going to exercise the option. The other one is length of the swap into which you would exercise. And a third one is the fixed rate, yield essentially of the financial instrument that you exercise into that you will own if you decide to exercise. So there is over 100, and a few hundred individual market quotes that altogether form this market data. So this data is high dimensional in the sense that it's more than a few dimensions. But, as I mentioned earlier, fortunately, it's less high dimensional than things like an image, which makes things simpler for us. It makes the models less computationally demanding. And because you cannot describe the evolution of each quote individually, we must be able to represent them collectively. But a model that has 50, 100, 200 state variables or parameters is very hard to build. It's very hard to work with. It becomes very unstable, where from day to day it can change significantly. So all of the models, and this is not limited to the models we've developed to encoder market models, but even the conventional or classical interest rate model, perform dimension reduction. And dimension reduction is when you learn how to represent all of this collection of market quotes, that there are many of them, so it's high dimension, using fewer state variables. Most of the interest rate models today in production, I'm talking about conventional models, use 2 to 5 state variables. So it's much fewer than the number of market quotes. And this is what is meant by saying that the state variable space is low dimensional and dimension reduction has to be performed.
So what is a variational autoencoder, otherwise known as VAE? How do VAEs fit in with CompatibL's autoencoder market models offering?
Generally, dimension reduction or size reduction, if we are talking about things like an image, is a compression algorithm. And the similarity between them can be understood very easily if we think of an image as essentially a set of pixels that you have on the screen. If you have a compression algorithm, for example, such as JPEG, of course, we're all familiar with that because that's how pictures on our phones are compressed. They are able to compress the image, reduce the amount of space it takes, in memory, on a phone or on a disk, by about tenfold. Because they are general purpose, they can compress any image or most of images. Variational autoencoders are machine learning algorithms that provide a fundamentally different type of compression. It has more power, but also it has a limitation. So the power of it is that the rate of compression it can achieve is much higher, not 10, it could be 100 or 1,000, but only when they are trained and used for the specific data. For example, JPEG can compress image of a face, image of a house, landscape, anything. But variational autoencoder, if you train it specifically to compress images of faces, it can compress up to 10 to 100 times better than JPEG algorithm, but it will only be able to compress faces well. If you give it an image of a house, it will not work well. So autoencoder market models that we've developed uses variational autoencoder, which is one particular type of autoencoder, and autoencoder generally is a machine learning algorithm that learns from the data, is trained on sample data to perform optimal compression, right? And then you can use it on other data of similar kind to perform compression on this data it has not seen before. So autoencoder market model is trained on historical financial markets data, which is high dimensional. And we just discussed yield curve, volatility surface, volatility cube, which has dimensions of tens, hundreds, or over 100. And it learns to compress it into these 2 to 5 state variables optimally. And that's exactly where we take machine learning concept that has seen tremendous success in fact, most of the successes in machine learning that you've heard of before in areas from speech, text recognition, image recognition, many of them in one or another way involve autoencoders and specifically variational autoencoders. We take this amazing machine learning innovation and apply it to financial markets to compress this high dimensional data into few model state variables.
What is the point of applying variational autoencoders to the challenges of complex modeling for interest rates that many firms are facing?
Right. So the main motivation for this is, if I may, is respect for financial markets and willingness to learn from history without preconceptions. And what I mean by that is that if we take conventional interest rate models or generally conventional quant models, namely models that banks, financial institutions, asset managers use to measure the risk and determine the value of their portfolio, they're based on equations. So the way these models are applied is that a set of equations is derived, and then the data that you observe in the market, either today's prices of instruments or historical data, is then adopted, or rather the equation parameters of the equations are calculated, or the word for this process is calibration. So they're calibrated to market implied, meaning today's prices, or historical data. But when you make this first step of selecting the equation, you already constrained what the model can do. You hope that your equation represents historical data well. But any equation that you write down that has a simple formula will not represent financial markets data perfectly, because the markets, they don't move according to neat equations, right? They're messy. All kinds of behaviors happen. It's very hard to write an equation using a pen, and a piece of paper that will describe something like financial markets. So with development of autoencoder market models, to us, it's essentially developing the model with full respect for how financial markets operate, and willing to learn from history without preconceptions or rigid boundaries created by writing down these equations. When we train autoencoder to the historical data, we're able to make the model produce essentially predictions or produce prices or calculate risk based on what the markets did in the past, and without any arbitrary choice of equation.
How can they help with interest rate portfolios, managing limits and add-ons, and then also credit exposure?
Right. So the reason we applied these models first to interest rate markets, even though this particular model category, autoencoder market models, is applicable across multiple categories, but we specifically applied them to interest rates because interest rate portfolios tend to be very long dated, and conventional models are based on rate increments. So most of the conventional models, and some of the most popular conventional models, they start from today's market, and then they model increments or changes relative to today's market. One of the reasons this is not as good as modeling the actual market as opposed to the change in the market from the initial state is that, as we discussed earlier today, during market turmoil, the future evolution can take us very far from today's market. So that's one shortcoming of this approach. But the other one is that if you go over a very long time horizon, some of the interest rate portfolios, or many of the interest rate portfolios, have instruments of 20 to 30 year maturity. And, there are some portfolios of fixed income that have even longer maturities, up to 50 years. So when you go that far in the future, 20 to 30 years, the initial state should be long forgotten, right? So in other words, if you model 30 years in the future, really what your model is predicting 30 years in the future should not depend on the exact initial point that you started from. And the longer this horizon is, the better the approach of autoencoder market models is, because these models represent the curve surface or volatility cube state as opposed to the change from the initial state. So in a market turmoil, when there is a big change over a short period of time, or in any markets, when you just go long enough, 10, 20, 30 years, the models that represent the state, namely what the curve is, as opposed to how it changed from this very distant point in the past, so the autoencoder market models that represent the curve itself, work better. And this applies both to things like pricing and value adjustments. And this is what quants call risk neutral measure, as well as things like risk and limits, which is what quants call P or real world measure. And this is why these models are especially suitable for interest rate portfolios or any other portfolios that include long dated instruments. But they also work for any portfolios during market turmoil.
Okay. Why do autoencoders potentially yield models with predictions that are better than traditional methods?
We expect this to be the case because we learn directly from the history. And there is a very well-known adage that history repeats itself. So by learning from the history and not relying on equations that somebody wrote down with a pen on a piece of paper, we hope that this model work well. And the data that we've gathered testing these models is very encouraging and points to that this approach is correct. And because the models learn from history, they're able to better fit the markets without the constraints of the equations. And you can literally see it in the predictions they make. For example, sometimes yield curve, when they go, yield curve or rather, the yields of different instruments of different maturities, they behave differently for near zero, very low interest rates. Sometimes rates even go negative, from mid-range interest rates, from very high interest rates. And because autoencoder market models learn from historical data that includes all of these regimes and can represent all of them well, whereas conventional models best represent the regimes best that are similar to the initial state, to the markets today. And they become progressively less accurate when the regime changes. So this is what makes autoencoder-based models potentially better models compared to conventional models. And the data that we have so far, as well as data by other research groups that have adopted this approach, support this very strongly.
So it appears that cloud computing and the push for digital transformation are serving as pillars for the move to autoencoder-based models. How are the cloud and other IT innovations helping bring down costs for cutting-edge autoencoders?
I'll give two-part answer to this question. So one of them is that because we're not dealing with images, we're not dealing with speech, and we're not dealing with text, the overall computational effort for this specific type of model is actually moderate, right? So in other words, training takes minutes, sometimes it takes an hour, but these are not the models such as some of the very well-known machine learning models, for example, for language, that require millions of dollars in hardware investment even to train them. But this being said, I still think that there is a very strong influence of the availability of cloud and digital transformation in practical adoption of machine learning models. Because with any machine learning model, and some machine learning models are more demanding computationally than this particular type of model that has moderate computational requirements, the computationally intensive training process must be performed from time to time. And when you have a cloud implementation, in the cloud, you have pay-as-you-go model. So in other words, if you have a massive computational requirement for an hour or, for an hour every quarter or, for, let's say, 10 minutes every day, you don't have to make a massive investment in hardware that would sit idle the entire day except for this initial, 10 or 15 minute period when you use it intensely. So cloud is extremely well suited for machine learning because of its flexibility in capacity, where you can increase capacity. It's very scalable when you need it, but you don't have to pay for the capacity you don't use. And with machine learning, it's a very typical load pattern where there is an intense computational demand during training and very, very little during model use. So cloud generally is amazing for machine learning. And in fact, I believe that a lot of machine learning research and a lot of adoption would not have happened if cloud was not available or if banks did not transition to the cloud, because that would have made the cost prohibitive. Another aspect of digital transformation that is extremely important for adopting our autoencoder market models or any other machine learning models is the tremendous progress made by the open source community in releasing very powerful Python-based machine learning and math libraries and making them available in the cloud at minimal cost. Because performing machine learning research or running the model in production, if you have to build everything from scratch, it would require a massive investment in IT infrastructure, in all of the code around storing the data, running the model, etc., that only major banks or major asset managers would have been able to afford. But today, as part of the digital transformation, major cloud providers, as well as most, I would say at this point, most cloud providers have very specific services available at minimal cost commercially that make it possible to run machine learning models with all of the infrastructure already built in. The various studios, I don't want to talk about specific vendors or the products, but generally there are all kinds of machine learning studios, machine learning tools, and all of that makes it lowers the barrier to entry. It makes it possible if your firm, does not have, $100 million IT budget, and even if, it's a very small firm, let's say, a bank, financial institution, in a startup hedge fund, you're able to leverage this infrastructure and only pay essentially for the time in the cloud. It is provided in most cases for free or at very nominal fees. So I believe that all of that, both the ability to have elastic loads when you can have heavy computational load on demand, as well as the ability of machine learning tools as part of digital transformation, have tremendous importance for the adoption of machine learning in mainstream financial institutions, basically banks, asset managers, and so forth. But again, I wanted to, in conclusion, to reiterate that while other models that we may develop in the future may be more computationally demanding, this particular model type, encoder market models, you can even run it on a laptop or on a desktop or basically with minimal cloud implementation. So it's not such a computationally intensive model that it would require the cloud, but other machine learning models are, and that's where the cloud is extremely important.
And lastly, what kind of a reaction are you getting from financial services firms when you talk to them about the autoencoder market models that you are developing?
Yeah, so there is tremendous interest, and the presentations we've done, the workshops we've done, webinars, we have record-breaking attendance. We, as far as I understand, broke for a recent webinar, we actually broke the record on attendance for this particular webinar provider. So there is tremendous interest. But also, these models cannot be used in production unless regulators and auditors are comfortable with them. This is why in developing these models, we took a very conservative approach. And we followed the principles of trustworthy ML, trustworthy machine learning, in making the models easy to understand, easy to test. The machine learning training is a step in model development, and the output of machine learning can then be examined in detail before it's used in production. So one very strong advantage of this model is that after machine learning is done, you can examine the output, which is not always possible for every machine learning model. So we're getting very strong interest. There's generally tremendous interest not only in research, but also in production implementations. And of course, we've implemented it in our software suite, which is the same suite we use for research. But right now, I think the challenge is to make sure that regulators, auditors, as well as internal risk control groups are fully comfortable with how these models perform, with the properties, that they compare them and see the advantage compared to conventional models. And this is something that we're very engaged in right now, working with other research groups on additional directions in this research, as well as working with our clients and generally with financial community in better understanding these models, creating adoption on these models, and making sure that if any bank group or research group would like to try these models and compare them to conventional models, we will fully support them in their efforts.
Excellent. Thank you for your time, Alexander.
Thank you for having me.